For 2 years, AI has written emails, made summaries, drawn pictures, but office efficiency isn't what moves the economy. What moves it is one machine on the factory floor, and whether it can avoid just one more minute of downtime. This episode, we're going to look into a factory. In last episode, we talked about Eaton. Eaton's job is to get electricity safely and reliably into data centers and factories. But once the power is in, the real work is just beginning. A multi-million-dollar production line. If it keeps breaking down, running below capacity, and producing too much scrap, then even the most stable power supply is a waste. Today we're looking into a company called Rockwell Automation. What it does is simple. Once the electricity is in, Rockwell makes sure the machines run with higher efficiency, less downtime, and lower defect rates. Rockwell's logic is more solid than most AI concept stocks, but its price already reflects a good deal of that solidity. What role should it play in a portfolio? When does it deserve attention? And when is it better to wait? Those are the questions we'll answer today. The ROI of Office AI is notoriously hard to measure. An employee uses AI to draft an email. How much extra profit did that generate for the company? Nobody can really say. For most software tools, the ROI ends up at the level of, it feels more efficient. The factory floor is a completely different story. 1 hour of downtime on an automotive assembly line, the loss is calculable. It could be tens of thousands, hundreds of thousands, even millions of dollars. A 2 percentage point reduction in defect rate, the cost savings are equally measurable. So here's the thing about Rockwell's products. Customers can figure out their payback period before they even buy. Rockwell doesn't sell on vision, it sells on data. Rockwell's products portfolio covers the entire chain, from sensing to actuation, from control to optimization. It doesn't need to prove that its AI model is the best in the world. It just needs to show one thing. A factory with Rockwell runs more efficiently and at lower cost than one without. But there's a constraint here that's easy to overlook. Upgrading an automation system isn't like downloading an app. The customer has to shut down production, retrofit the line, recertify equipment, and retrain workers. That usually requires a capital budget approved a year in advance and a clear ROI calculation, especially in a high interest rate environment. Rockwell sells rational investment decisions, not impulse purchases, so its order book is tightly governed by the rhythm of industrial capital spending. If you're responsible for an assembly line that produces hundreds of thousands of cars a year, the control system is the nervous system of your entire plant. Would you rip out that nervous system just because a competitor offers a slightly lower price? Replacing an automation platform isn't like swapping out a computer. You have to reprogram everything, recertify every device, and retrain your entire technical team. And during that transition, your production line could be down for weeks. For the customer, the cost of downtime far outweighs any price difference in the equipment itself. Rockwell's moat can be summed up in 3 words. Customers can't switch. Once Allen Bradley controllers and FactoryTalk software are embedded in a factory, subsequent expansions, spare parts, upgrades, they all tend to stay within the Rockwell ecosystem. The second quarter financials confirm the value of this business model. Intelligent devices grew 13% with operating margins around 21%, but software and control grew 20% with margins approaching 35%. Hardware is the entry point. It locks the customer in. Software is the profit engine. It scales the value. This structure is the real foundation for Rockwell's long-term valuation growth. In the second quarter of fiscal 2026, Rockwell's income statement looked immaculate. Revenue reached $2.24 billion, up 12% year over year. Adjusted EPS came in at $3.30, up 32%. Operating margins expanded from 19% to 22.5%. The company also raised its full-year revenue and earnings guidance. But the cash flow statement told a somewhat different story. First half free cash flow came in at $445 million, slightly below the $464 million from the same period last year. Management attributed this to incentive compensation payouts and higher working capital requirements. This is not a financial crisis, but at a 36 times earnings valuation, the market pays close attention to details like this. If cash conversion improves in the second half and the company delivers on its full-year target of roughly $1.5 billion in free cash flow, then the first half was just a timing mismatch. But if cash flow continues to lag behind profit growth, investors will have every reason to question the quality of those earnings. One more detail worth noting. The company spent about $454 million on share buybacks in the second quarter, slightly more than its entire first half free cash flow. Large buybacks at elevated valuations, paired with increased short-term commercial paper borrowing, that's a capital allocation pattern worth keeping an eye on. Let's start with the balance sheet. Rockwell's long-term debt maturities are well spread out. There are no large near-term walls, just $250 million due in 2028 and $425 million in 2029. But there's about $1 billion in commercial paper outstanding, with an average maturity of just 28 days. Under normal credit conditions, that's a low-cost source of flexibility. But if credit markets suddenly tighten, that short-term rolling debt becomes something to watch closely. Now valuation. As of early July, Rockwell's stock price was around $467. The market's consensus EPS estimate for this fiscal year is roughly $12.80 at the midpoint. That puts the forward PE ratio at about 36.5 times. A 36.5 times multiple is not cheap for an industrial automation company. It means the market has already priced in three things simultaneously: a recovery in manufacturing capital spending, continued margin expansion from software, and AI actually delivering measurable efficiency gains inside factories. If all three happen, earnings growth can gradually digest the valuation. But if the cycle turns out to be just a short-lived bounce, or if cash flow fails to keep up with earnings growth, then a multiple contraction from 36 times back to 32 times could put significant pressure on the stock, even if earnings are still growing. At current levels, the stock already carries a considerable premium for certainty. Technical analysis answers a more practical question. Has the market already overreacted to the known good news? $482 to $497 is the resistance zone near the prior high and valuation ceiling. Without new earnings catalysts, chasing at these levels offers poor risk-reward. $450 to $465 is the first observation zone, near the 35 to 36 times valuation range. Watch for stabilization signals here. $421 to $430 is the May earnings breakout level and an important midterm cost support zone. $395 to $410 corresponds to a 30 to 32 times multiple. If fundamentals stay intact, that's where the margin of safety starts to look more attractive. After the May earnings release, the stock jumped nearly 9% in a single day, breaking decisively above the $421 level. But by late June and early July, as the stock approached its $497 high, some interesting signals emerged. Up days came on shrinking volume, down days came on expanding volume. That doesn't necessarily mean the trend has reversed, but it does suggest that profit-taking is increasing at the highs and the pool of buyers willing to chase is thinning. Based on fundamentals and the current technical setup, Rockwell is better suited as an industrial growth holding in a portfolio, not as a core defensive asset. One reference approach: when stabilization appears in the 450 to 465 range, build a small observation position. Wait for second half free cash flow data before considering an add. If the stock pulls back to the 421 to 430 zone and fundamentals remain intact, the margin of safety improves. If the stock breaks below 421 with deteriorating fundamentals, weaker orders, worsening cash flow, or negative guidance revisions, that's not a buying opportunity. That's the signal to reevaluate the thesis. If AI only helps people write emails and summarize documents in offices, the market it can support will always be limited. It's only when AI enters the factory, when it reduces 1 minute of downtime, saves 1 worker hour, or cuts 1 batch of scrap, that it truly transforms from a software story into real economic productivity. Rockwell sits at the center of that transformation. It has real installed assets, customer switching costs, high margin software, and the long-term tailwind of manufacturing modernization. But the price already reflects a great deal of that optimism. Over the next 12 months, the key variables for Rockwell's performance are not AI hype. They are: can cash flow keep up with earnings growth? Can manufacturing capital spending continue to improve? From power infrastructure to factory automation, this series has covered 3 episodes now. All of these assets have clear demand logic in the AI era, but they all share one common trait: they remain exposed to economic cycles and fluctuations in capital spending. Next episode, we're going to shift gears. We're looking for an asset class that is almost entirely independent of AI investment, yet can consistently generate cash in a high-rate, high-volatility environment. Chubb, why an insurance company might just be the real defensive holding in this market.